and the balance sheet analysis. What we did was, for our same campuses, just as a background, we shared our data with Lee's team, and he started evaluating balance sheets and financial profiles.
So I'm your investment banker, and I'm here to tell you it's not all hopeless. We think. Yours is a tough job. It's difficult to make the decision between operating needs and capital needs. And frankly, it really comes down, in my view, to capital choices, to real policy choices by you. And I think the data is compelling that more of your asset base, more of your income statement needs to be devoted to that fundamental asset investment that you have on your campuses. So I'm going to start a little bit with the bottom line, the kind of the conclusions first. How do you fund any kind of need on your campus? Well, here are the 5 places. You pay for it out of your operating budget, your income statement. You have reserves. You can dip into those. Some have been board designated. Some are otherwise accumulated. Best way, somebody gives you the money, a gift. And if you're a state agency, it's a state appropriation gift. They write you appropriate. I used to be the budget director for the state of Colorado years ago. We had a big budget for deferred maintenance for all of our public institutions. Today, minuscule. So we know that that's not as available as it used to be, but it's still there sometimes. And some states do GO bonds, which they pay for to give you the money if you're a public institution to either build new facilities or repurpose or redo your facilities. And then there's debt, which is a choice in the mix. It's not always the most preferable choice, but you should think about it. And here's the things that you would think about when you think, should you enter into debt for purposes of an asset repurposing or asset renewal. One is the cost of capital. If you want to use reserves on your balance sheet versus borrowing, you think about the opportunity cost. What's the return on those reserves on your balance sheet? In a good market, can you make on average 6 or 7 or 8% versus what the cost of capital is? Today, roughly 4-ish% for most of you. That's one way to view it. The other way to view it is from an income statement point of view. Are the operating cost of the building that's deteriorating in front of your eyes growing at such a rate, plus the cost of renewing that building, construction price inflator, are the combination of those two costs to you growing faster than the cost of capital? And if they are, if that math is more than 4 or 5%, which is your cost of capital today, then you're probably costing yourself money by operating a facility that's aging too rapidly and costing too much, maybe in utility expenses or other expenses, to pay for out of your operating budget. So under those circumstances, that's when debt becomes a consideration. And in terms of the term of the debt, some of you borrow for 30, some for 40 years. Wouldn't recommend that necessarily for these kind of investments because typically when you make these improvements, their asset life is shorter than the design life of the building, maybe 15, 20 years. So you don't want to issue 40-year debt if you're going to improve your building for 20 years, just kind of a rule of thumb. And then finally, the bottom line is, as an investment banker, all the investment bankers in the room, all of us say the same thing. We want to keep your ratings as high as possible. And that's kind of an instinct of all of us, to tell our boards we've got a great rating. Well, I'm here to tell you today that that may not be your ultimate policy objective. The rating agency, folks, if they're here today, will tell you, don't let the ratings drive your policy, have your policy drive the rating. And so if you need to make an investment in your infrastructure, either by drawing down expendable resources or making your debt service coverage margin deteriorate a little bit, and you lose a half a category in rating, do it. If it makes strategic, if it's in your institution's strategic long-term interest. There's something called credit spreads, which is the difference between a particular rating in terms of cost of capital in the capital markets for 30-year debt compared to a benchmark. So the credit spread right today, or last week, for if you're a AA rated institution for a AAA, about 27 basis points additional cost of capital on a 30-year bond issue. Between AA and A, about 44, and A and BBB, 62. So that's quite a gap overall between all of them. But 20 or 30 basis points higher cost of capital if you have to take a downgrade because you're doing something important, something vital to make your institution thrive, then I personally think you ought to do that and consider that, as opposed to hold on to a rating for some sort of theoretical prestige purpose. It's more important to make the campus work than to boast about your rating. So here, go back a slide. You've got the, yeah, that. So here is a database we picked. We're going to do publics first and then privates. Here is a database of 20 institutions in the Sightlines. Here's an array of 20 institutions in the Sightline database. This is an average of their capital spending targets for the last 5 years. This is the actual data from maybe some institutions in this room that show on the left-hand axis what their funding gap. The dark blue bar is how much they have spent on average over the last 5 years out of their operating budget for this capital improvement target spending. The light blue is their one-time spending, and the red obviously is they didn't make it. They didn't fund all their targets. And this is arrayed by rating categories here, the AAA schools over there and the lower A schools over there. Some of you may know that for public universities, very few triple Bs, almost all in the AA, or AAA category. So then now my job is to try to put financial metrics on top of this and see if we can tease out some conclusions from this. So we looked at the debt service coverage ratio from each of these schools, went through the rating reports and said, okay, what's their debt service coverage ratio as of 2012? That's the yellow star. And the big yellow sticky over there says, all these institutions, every one of the 20 in our database but one had an operating deficit last year. Every one. Yikes. Kind of a sad statement about public higher education. But you see their debt service coverage ratios are kind of all over the board. In other words, you would think, well, maybe there are some lower ratios here for the A schools and some higher for the AAAs and higher, and go to the next slide. But when you compare those to the Moody's medians for that category, we could have used S&P, so I hope I haven't offended my S&P friends. You'll see that the coverage ratios here are generally in line with the medians for their category. This school here, this AA2 school here, had the most capital spending from its budget, but came up short for its debt service coverage ratio. And so this tells me that there's not a lot of room in their operating budget to make improvements in the capital without sacrificing some degree of debt service coverage ratio protection. That's kind of my bottom line as a banker here. So let's move on to the next slide. Oh, he went too fast. So let's look at the balance sheet. That was an operating budget slice. Let's look at the balance sheet. Same schools. And now we're going to look at their expendable financial resources to debts. There we go. Those are the purple dots. That's a ratio metric the rating agency used. What's their kind of balance sheet expendable ratios, excluding true endowment. So cash and investments as a ratio to debt. And you can see that the higher rated schools have a little bit more balance sheet strength above the medians. So they could make the policy choice, let's draw down the reserves and make some investments in our campus. That's what that says to me. But you see where all these purple dots over here at or below the medians? Not as much, no surprise, duh. Lower rated schools, not as strong a balance sheet, and less capacity on the balance sheet to make investments from their cash and investments at the current rating category, kind of my bottom line here. So they have less flexibility to fund the gap at the lower public range. Okay, next slide. And so this slide, this is the last slide on publics, and we're going to do the same thing for the privates, says the triangle, whatever color that is, kind of shows on the right axis the total asset reinvestment backlog per square foot. So this is a metric that Sightlines uses to calculate how many square foot on the campus, what's the total backlog, dollar backlog. This is we've done it for 2012. And they've come up with $1 per square foot. And on average, go to the next slide. Oh. Operator error, okay. On the average, it's, I think, $79 per square foot. So if you have 1 million square feet times $79 million of backlog that you really believe need to be funded on your campus to bring it up to current appropriate status. And these backlog numbers are kind of all over the board. You would think most of them would fall in the lower rated categories, and there are a bunch of high backlogs, 100, 120, 140, almost $1 per square foot. But there's one here at a AA 2-rated school that's pretty darn high too. So in general, maybe more grouped here for the higher rated schools and over there, but still, bottom line, tons of backlog. Lots of money to be spent per square foot on those campuses. Okay, next slide. So let's do the same thing for privates. So here are the gap. The reds are the gap, and the light blue is the one-time spending, and the dark blue is kind of how much is in their operating budget, a kind of funding depreciation concept. And just as an example, the one we pointed out, that school in the A category, it's so dramatic that its backlog is so dramatic, and we could have pulled up bullet points for other schools too, but we happened to notice this when we read all the credit reports. It's really, Moody's has said, you know, your plant is so old, you're so behind the times, you really, as a strategic objective of this institution, you got to put some dough in there. And they put a fair amount of budgeted spending into that, and they put almost no one-term spending into their plant and asset mix. And the rating reports might say the others, like for example, this one, the very first AAA school, gigantic deferred maintenance needs. So next slide, David. Okay. So we're looking here again on the debt service coverage ratios. We've overlaid that to say, if they've got a high debt service coverage ratio, do they have room in their operating budget to build more depreciation spending into the plant and equipment and draw down the debt service coverage ratio? And sure enough, as one would expect, the highly rated schools seem to have lots of rooms. They've got the yellow diamonds are pretty high up of the scale, and they're well above the medians for the rating category. So that would suggest to me they've got a lot of room. These guys, yikes. No wonder the dark blue is so small. They put almost no money out of their operating budget into their plant. And the reason is their coverage ratio is almost zero. It's pathetically low. So they're operating on the margin just with their operating budget. They're not building. They don't have any cash being generated to do that. They can barely cover their debt service coverage ratio. They're basically a one-to-one coverage ratio. And as you would expect, the lower rated schools, and of course we have lots of BAA rated schools in the private sector, have more struggles with coverage that's not as robust as higher rated schools. But some of them are well above their medians. And so if I was that CFO, I'd say, okay, 3% faculty increase or 2% faculty increase, maybe I should dial it back a notch, risk the wrath of all my colleagues, and put a little bit of dough into that plant so they have a place to go to work. That's the policy choice. That's a part of your job, a difficult one, but you signed up for it and you love it. I'll go back a slide. So here, go back. It doesn't like to go back. Okay, well, we'll deal with what it is. So here's the now this is the balance sheet take on this. So we went back and looked at the expendable financial resources to debt ratio, how much cash and investments they have, and that's the blue dot, and it compares to the medians. And wow, the expendable resources to debt is really low at almost all these schools unless you're really quite well off, and right at the medians. So that says to me there's not as much room to pull down reserves or capital for these projects, particularly for the lower rated schools. And let's pull, you can see the one here, they've got gigantic expendable resources, a 12 times coverage ratio. That's the exit on right. So their expendable resources is 12 times their amount of debt. So they've got $100 million of debt. They've got $1.2 billion of resources, a big number, something like that. So they've got a lot of room. These other folks do not. This one cannot use any expendable resource to fund the gap because it's so darn low. Same for these over there. This one has a very small gap. Great to them because they have used a one-time spending. They probably dipped into reserves. I don't think they got gifts for, repairing a chiller. So they probably dipped into reserves and made a conscious decision to really reduce that gap, and kudos to them. Next. Here is the backlog per square foot from these campuses, and this looks like, what was a scatter diagram that doesn't mean a lot to me if you first look at it because it's all across the board. But David has a theory.
Yeah, well, as we were looking at these, and on the public side, you tended to see the campuses with a lower debt rating have a higher backlog. It was a general move kind of to a higher backlog. Here, I think you're seeing as the debt rating goes down, you're seeing the backlogs be a little bit more modest, actually driving down. And and as I've talked to folks on the private side, it's very interesting. The campuses that have less debt capacity, they rely on their facilities much more for the condition of them, for enrollment, for recruitment, all those kind of dynamics. That's a key asset, and so they tend to be a little more attentive to those facilities. The campuses with lots of assets, they tend to say, okay, if when the time comes, I can actually take a debt, or I can actually move forward and restore these facilities in one blast, so I can move it quickly. So it tends to be that we tend to see a little bit higher stewardship and a little bit higher focus on those campuses where their capital capacity is diminished.
When I first look at this chart, I agree with all of that. And I was kind of struck by almost all of them are at $90 or below reinvestment backlog per square foot. A few are kind of really high, but most of them are in the lower category. And geez, here's a couple of BAA2 schools, good for them. $20 per square foot. They have done a ton of work with very little resources, I'm sure, to keep their total backlog really quite manageable. Way to go. I should give them a shout out, but confidentiality review, you can't do it here. And the same for these schools over here. So that gives me reason to think that it's a policy choice, that these folks have made, these CFOs have made a really good decision. Have kind of said, I don't have all that good a rating, and these guys, even with the good rating, they kind of said, we're going to put money into the plant, and we're going to really manage this, and we're going to keep our campus an asset that I can pass on to the next CFO without having him or her curse me, because I just didn't pay attention to kind of what was falling down around all of us. Next slide. So it's always a difficult decision, but I really believe it's a balancing act, a tough choice, but I firmly believe you're in charge, you make the decision, that's what you get paid to do, and you're all good enough to do it. And you have to just kind of figure out how to balance the budget versus put money into the capital plant. And it's difficult now because state appropriations are tough for public institutions. And for the privates to stay competitive because of in many states, the declining enrollment growth projections. You got to stay competitive. You want kids to come to your campus. You want them to buy that education and feel it's a great value for them. And so you have to make that difficult decision about how to find the dough to do it either off your balance sheet or your income statement. So to conclude, here's some 4 or 5 steps to 4 or 5 kind of takeaway things. Increase revenues, duh, it's easy for me to say that. Yeah, just raise tuition. You've been doing that too much already, and you know that. So, but increasing enrollment, that's really the question. And increasing enrollment has the great effect of increasing density, getting better use and utilization over those facilities. That's the component that Sightlands is excellent at, in figuring out how to, if you can have that incremental growth, how to put it into facilities that you get better productivity out of. You want to use your assets productively. And tuition, and even if you don't grow enrollment, figure out how to squeeze more classes into fewer buildings, basically. Increase campus diversity. We're not talking about ethnic diversity, which is an important thing, but diversity in terms of the use of the building. So Repurposing buildings. Sightlands is great about having lots of examples about buildings that were built for X, but now can be used for Y. And that's a lot cheaper than building a new Y building. Think research labs. Decommission facilities. That's the low-hanging fruit in my view. And I would take that right back to the campus and think about it every day.